Hello everyone, welcome back to my channel. My name is Debbie Lee and today I will just set up this live stream. So I hope everything is working in frame. Alright, okay, so I just want to welcome everyone back to my channel. If you are here currently on the live, I welcome you. If you want to grab a drink or anything, or maybe some food or some snacks, we are going to be here for quite a while. It is going to be at least an hour, so get comfy. And all right, so I guess we'll just get straight into it. So I would like everyone to be welcome back to my channel. So on this channel I talk about financial freedom and how to acquire and everything in relation to investing and stocks and the trades and markets and everything like that. So yeah, so my time at White Samurai over the past year, I have been working under David Rains, the COO, and it has literally changed the way that I see money, the way that I look at my own money, the way that I look at everyone else's money. And it has been an eye-opening experience, to say the least. So yeah, so this is why I created this channel. I want to just get the message out there for all of the people that struggle and all the people that think that this is the only way to live, because it is not. Trust me, I have been there. I am a self-confessed working class girly, so I am born and raised in the middle class, the lower middle class. So yeah, and then I moved over to the US and then here I am. So let's begin. So before we get into any of the trade or market behaviors today, any of the topics on today's video, I want to just talk about a really great example before we get into it. So I really love using the example of Apple. I mean, you've probably all heard it, right? But I mean, it's a very popular story because of how everything happened. And yeah, so I just want to talk about the rise of Apple, the vision of failure and rebirth. So before we cover the topics, let's us just get into it. So the story of Apple, you might think that it is quite boring and you've probably heard it all over everywhere because it is a very popular story for good reason. So I do just want to talk about them, and I want to talk about their beginnings. So they do have very humble beginnings. So basically it was just the two of them. So they were in their garage. They were surrounded by wires. They had coffee cups laying everywhere. It was just like a mess, right? And it just felt like impossible for them to see their vision coming to truth. So, who are we talking about? We're talking about Steve Jobs and Steve Wozniak. So, Steve squared. I mean, they could have picked a more different name. Anyway, so Jobs was the original storyteller. He was really good at, projecting the company's truth and authenticity to the public. So he was the visionary, and he was the one that could see what didn't exist yet. And Wozniak was the builder. He was the brute force behind the company. So he was the engineer and the quiet brilliance behind the circus. So one without the other could not have happened. It couldn't have got off the ground at where they started from, because it would have just been a mess. And so they were complete. So they were complete in the way that they worked. They both had different ways about doing things for the company, but it worked for them. So let's just also be clear, because Apple didn't start businesses with all the rich men. They didn't start with funding or connections or confidence. They started because they were obsessed with So they were obsessed with the idea that technology could be beautiful. And computers didn't have to have cold exterior. They didn't have to be one size fits all and ugly. They didn't want to make ugly products. So that was quite intimidating for the everyday person, because that's not, at the time, that was not what they were used to. Everything was big and fat and clunky. And even though their first product, the original Macintosh desktop computer, it was still quite clunky, but it was very refined. And so all of the everyday people, they just weren't used to anything like that. So they could have had access to the power of computing, not just corporations and labs. So this was radical at their time, at the time of when everything started to happen. So technology back then was just kept behind doors. Everything was personal. Everything was, like shut behind a door. So something only the qualified and the elite were allowed to touch at that time. And Jobs and Wozniak said, no, regular people deserve power too. So I want that to just sink in for a little bit at the same time. So we want to bring the same energy here today. So Apple's first rise. They built, they sold, they pitched, they reinvested, they learned to fail forward. They weren't chasing money. They were chasing meaning. But here's where the story shifts. So as Apple grew, the pressure grew too. Investors began to care more about profits than product. The boards of directors became to care more about speed than vision. They wanted to just pump products out and not refine anything. So in one of the most unbelievable moments in history, in business history, Steve Jobs was fired from the company that he created. How does that even happen? So imagine that. Imagine putting all that effort in, putting all of that groundbreaking knowledge out to the public. All your work, your life's work, growing it, nurturing it, shaping it, and then being told, no, you have to be out of here now. You don't do it now. You don't belong here anymore. So it literally broke him, but it didn't end him, thank God. So most people think that success is a straight upward linear trajectory, but true success looks more like a storm. Like, you think about the calm before the storm, and then you think about the calm after the storm. So this was Apple in the 1990s. They lost money, they lost relevance, and they lost direction. But meanwhile, Steve Jobs was out there learning. He was still doing his part for himself. So he was reflecting, and he was failing differently, building differently. He learned humility, he learned patience, and he learned strategy. So he learned how to lead with clarity, not ego. So the same lessons from his story apply to this story today. And so it's not just through money and markets, that was through tech. So those ideas apply to investing in money and the markets. So the return of Apple, Apple came crawling back to Steve Jobs, and they were like, please, we need you back. And he didn't come back angry, or he wasn't like resentful or revengeful. He just came back, and he was focused. He was locked in. And he didn't say that we need more products. He said we need less. He simplified, he clarified, he refined, and he rebuilt Apple from intention, not from impulse. And from then, the magic, it was just their beginning. And boy, oh boy, if they only knew what was happening at that time to now. So the iPod, the iPhone, the iPad, AirPods, the whole entire ecosystem, the iWatch, everything. It literally defined my generation. So, and everyone else under me, which is crazy. That's such a crazy way to think about a generation in terms of how one product can be so synonymous with an identity. And some people live and breathe Apple. So anything can happen. So Apple, from then, they stopped being a company. They became the culture, right? Everywhere. So it is just ingrained in our DNA at this point. So people didn't just buy the devices. They bought the story. They bought the ecosystem and the belonging and the relatability. And the wealth followed that alignment. So not the other way around. So where does Apple stand today, you might ask? As one of the most recent US financial reporting concludes, Apple generates over $1 billion in revenue per day. Its market cap has crossed $3 trillion. inconceivable numbers. And nearly half of American households own at least one Apple product, at least one. Half of the population own one Apple product, which is not surprising, but those statistics are crazy. So because of that, the key part of the story is not about money. It's a story about emotional discipline required for growth. So Apple had a vision, and failure, redirection, mastery, and that is exactly how you will go. So that's what we are going to abide by in your way to approach trading. So it's not about winning, then winning, then winning, then getting rich, because that's not realistic. So it's going to more be like trying, testing it out, maybe failing, then reflecting, refining, and then using all of your combined knowledge to do it differently. And that is why we are here today, because the working class girlies and boyies and everyone else in betweenies, we don't want to feel like we have to survive paycheck to paycheck, because it's just exhausting. It's literally so exhausting. And we were raised to believe that we could build wealth. We were raised to stretch it, actually. We were raised to survive, to hold on, to make ends meet just until you get paid next week or the week after. But no one taught us how to participate in the system that creates wealth. And that ends today. And I just will leave a disclaimer. I am not a financial advisor. Please consult someone that is within the proper realm if you are going to tackle anything. Not even just financial purposes, but yes, take my advice with a grain of salt. And if you want to seriously delve into all of these topics today, please consult a financial expert. So the people at White Samurai are here, and just reach out, and they will be able to answer any question you have. So this live stream is not about rewriting identity. This is about saying, I belong in financial conversations. I deserve to understand money. I am not too late. I am not too small. I am learning, and that is enough, because it is. And if you feel that right in here, you're like, damn, yeah, that's me. I deserve to learn. I would like you to leave a emoji in the chat, or if you are watching this after, just comment, I deserve to learn. And if you want to learn where we learn, you already know where to find us, the White Samurai team, which brings us to today's 4 key learning topics. So today we're going to cover market trends, can't spell, market trends, explained simply. So we are going to cover market trends that will be explained simply. We are going to know when to exit trades, how journaling improves trading, and how the professionals think during volatility. volatility. So every single one of these lessons that I am going to cover today, I have learnt myself under the COO at White Samurai, David Rains. So let's begin. So the first topic is market trends explained simply. So let's just take a breather for a second and let's talk about market trends in a way that finally makes sense. When most beginners encounter charts or looking at the screen, it might just look like chaos. Green candles, red candles, all the lines, the curves, the numbers, everything's constantly moving, everything is constantly updating, and it feels like you're just staring there looking at the screen like, what is happening? Everything is happening all at once. But it's okay. I am here to kind of explain it, hopefully, in a way that you will understand. So, because the market is a language. It is the language of collective human behaviour. So when you think about it, it's all just projected happenings from us. So we're not just looking at numbers, we are looking at millions of decisions made by real people in real time. So people who are making these decisions are hopeful, they are fearful, they are impatient, and there are a lot of people who are greedy, and there are a lot of people that don't want to miss out, and there are a lot of people who want to feel smart and they want to feel in control. So this is why the market can feel emotional, because it is. It's a mirror of all of the things that humans don't say out loud. So what a market trend actually is. So a trend simply is the direction of the market that is moving over time, not in the next 10 seconds, not in a minute chart. There are only 3 types of trends. So there is the downtrend, and the upward, there is the uptrend, the downtrend, and the sideways / the range. Doesn't sound too crazy. So the upward trend is optimism, confidence, and the downtrend is fear, protection, withdrawal, and the sideways / the range is uncertainty and indecision. So the uptrend makes higher highs and higher lows. And the downtrend makes the price is lower. The downtrend makes the high lows and the lows low. So, because they all have a collective emotional state, this is why understanding the trends really matter. So you're learning to read emotion at scale. So that is why we are talking about this. Because beginners lose money not because they are wrong, but because they are trading against the direction of emotional momentum. They try to buy when the market is clearly selling. They try to sell when the market is clearly buying. And they believe they can predict reversals because it feels like the price is too low or it's too high. This is like trying to sprint across a strong current in a river. Doesn't make sense. But the river doesn't care about your emotion. It's a river. It just continues flowing because that's what its job is. But your job as a trader is sorry. Okay, so where were we? The river. Yeah, so the river's job is to keep flowing. And your job as a trader is not to fight the river, but your job is to read which way the river is flowing. So at the end of the day, it's your decision to step in if it's safe enough to do so. So that's kind of just a generalized way to think about what a market trend is. So, how do market trends form? So this part is crucial. So, trends form when large groups of people share the same belief. So an example is if most investors believe this company will grow, the prices rise. And if this company is in danger, the price falls. So the trend is simply visible trail of that belief. This is why trends don't turn around instantly. Beliefs don't change instantly. They shift gradually, the same way a person slowly changes their mind on things. So think about a crowded restaurant street. If one restaurant suddenly gets a long line outside, what happens? More people subconsciously assume, oh, that place must be really good. I wonder what's going on in there. Now, the restaurant across the street gets emptier because people walking by assume something must be wrong there. So they avoid it. So they go to the other one. So that's a trend because people are trending collectively towards one thing compared to another. Not because anyone actually analysed the food, but because they just followed a visible signal of collective belief. So markets behave the exact same way. So how do we identify a trend without overthinking? So the first step is to zoom out to a higher time frame. So if you're at 1 day or 6 hours, you want to go out to 4 hours. You want to go out to daily, 24 hours. Or you want to zoom even further out to weekly, maybe even monthly. Or maybe you just want to visualize everything over the past year. So if the chart looks chaotic, you were zoomed in way too close. Yeah. So step one is just zoom out. If it looks crazy, zoom out. Step 2, you want to draw the overall direction. So this is what you call the average. It's just an average line. So the upward diagonal over to the uptrend, and the downward diagonal is the downtrend. So when there's no clear diagonal, it's just the range. So step 3 is to look for repetition, not perfection. And by this, we mean when there is an uptrend, so the higher high and the higher low. So the uptrend is when we want to look for the higher high and then the higher, how are you looking at this? Higher. So you want to look at this side of the graph, the higher high and the low being higher. So everything is just up more. And the downtrend, you want the lower to be lower and the higher to be lower. Simple as that. So you want to just look for everything that are repeating themselves. So what is next? So we want to just make sure that it's not about being exact. It's about just recognizing the behavior patterns of that particular market, whatever it is. So what do we do now? So this is very important. So most beginners see a trend and think, I'll wait for the exact top to sell, or I'll wait for the exact bottom to buy. So this is where 90% of losses come from. You are not trying to predict the top or the bottom. You are trying to participate safely in the middle, aka the average. So that is the calmest part. So the middle of the trend is where the professionals trade. The top and the bottom are where beginners lose everything. So another example is, imagine trying to jump onto a moving train. One, why are you trying to do that? And 2, it's not going to happen. So imagine you're trying to jump onto a train, and if you try to time the exact moment it starts moving, you'll likely miss it. And if you try to jump on when it's speeding, you'll get hurt. But when the train is already moving steadily and you can see the rhythm, that's the safest time to step on. So trends are trains. Don't jump when it's chaotic, enter when it's steady. So just for number 1, so the goal is not to outsmart the market, because you are competing against all of the other masters at work, all the other professionals that do this as a day job all day, every day. They live and breathe it. So the goal is just to understand the overall emotional direction and to move with it and not against it. So let's get into topic number 2, knowing when to exit a trade. Knowing when to exit. So now that we've built the foundation of understanding trends, we need to move on to something that I consider one of the hardest skills in trading: knowing when to get out, knowing when to leave and exit. So let me just be very honest here and say anyone can enter a trade. Anyone can click a button. But exiting is the deciding moment to walk away. When enough is enough. Whether to walk away in profit or whether to walk away in loss. And that takes a lot of emotional strength. So it takes awareness and it takes self-control. And most people don't lose money because they enter the wrong trade. They lose money because they stay in the trade longer than they should. They stay because they want just a little more profit. They don't want to admit that they're wrong. They think the market will come back. They feel emotionally attached to the trade. That's a big no-no. Because you want your profit. How are you going to get your profit if you just stay in there forever? So we'll just call it what it is because it's hope. But hope is not a trading strategy. It's a feeling, and feelings are expensive. So why does exiting matter? Exiting a trade is an act of self-respect. So it's the moment where you say, I know my boundaries, I know my intention, I came for a goal and not for chaos. So when you exit intentionally, you are telling the market, I am not here to chase, I'm here to manage myself, because that's all we want to do day in and day out. Your opponent in trading is never the chart. Your opponent is the urge to just stay a little bit longer, because then you're just gambling at that point. So the problem that most people have, so most traders only think about entering. They don't plan their exit. They are already emotional. They enter a trade and then they say, I'll figure it out. It's things like this, like it's just like getting into a car with no brakes and saying, I'll stop when it feels right. No, because you can't. How do you know when it feels right if you can't feel it, if the brakes aren't working? So you're going to hit something, and that's how most trading accounts get wrecked. How do we fix this? So the exit must be planned before you enter. Always. Not sometimes, not, I'll do it while after I enter. No. This is the standard of professional thinking, and you want to trade like a professional. So for you to trade like a professional, you need to think like one. So 3 simple steps to exit a trade intentionally. So before you enter, you have to define your profit target. It's not a feeling, it's not a number, it's not a vibe. Step 2, you want to set a maximum loss limit. So that is called a stop loss. So it's deeper than a stop loss, it's a boundary, not because the market demands it, but because you respect your own capital. So if the trade hits your boundary, you close it. You breathe, you walk away, and you forget about that trade for that day because that is all you came to do. So step 3, you need to accept that missing out is cheaper than holding on for too long. So this is the hardest emotional part, and it is always better to exit too early than too late, because you will never regret leaving with profit. You will always regret watching your profit turn to loss, and you don't want to do that. So an example, will I do an example? Will I have time? No. So some common mistakes when trading to avoid. So most beginners exit only when they fear. They don't exit because... Oops, my mouse is not working. Sorry. Where's my... Oh. Hey, where did that go? So, they don't exit because their plan said so. They exit because panic told them to. So that means they are trading from emotion rather than structure. Did that just drop out? No, that should be fine. There we go. So, they trade from emotion rather from structure, and you don't want to do that. So you need to exit on rules, not on feelings. So you need to say this line clearly. The market doesn't hurt people who have a plan. The market hurts people who hesitate. Just remember that. So the third topic of today is how journaling improves trading. So I just want to talk about something that sounds a little boring, and you might be thinking, oh, why do I need to journal? This isn't a psych appointment, but it may as well be, because do you want all your profit to be lost? No. So this is a very powerful habit that a lot of professional wealthy traders abide by. So journaling your trades, yes, and I literally mean literally writing them down, getting a piece of paper, getting a little book, just for you, because you need to see all of your patterns. It's hard for you to realize what you're doing in the moment or even after because you don't think in detail like that. And trust me, it's a lot easier for pain and suffering. So some of us rush, some of us hesitate, some of us chase and panic and get addicted to, that rich feeling. So these patterns don't just show up in the charts because they don't need to. They don't do that. So they just show up in your behavior. So the journal is where you learn to observe yourself. Because trading is not about controlling the market. It's about controlling your reactions to the market. So, a trade journal would show what you were thinking, what you ignored, what triggered you, and what repeated. So this is where improvement begins. You cannot evolve what you don't see. You can't improve what you don't know, and especially what you don't understand. So what do you track? Little. So in your little diary, I want you to just write some little notes and know when to exit. Yes, that's this one. So I want you to track these points. So I want you to take note of why you entered. I want you to take note of why you exited. I want you to take note of how you felt. During the trade. So it's not numbers, your journal is for your feelings, unironically, because though the charts don't reflect what you're feeling, obviously. So 3 steps to journal like a professional. I want you to it doesn't even have to make sense to anyone else. If it just makes sense to you, that is okay. So I want you to write before the trade. And I want you to do that because you don't want to get into something where you're thinking, I don't want to miss out, so I have to do this. You want to take note of why you're feeling that way so you don't do it in the future, just in case it causes you detriment. So I want you to also write during the trade. I want you to take note of how you're feeling, what you're reacting to, if you're happy about something, if you're anxious about something, if you're annoyed about something, just take a note of it. So it takes you kind of away from what you're looking at and how you're feeling. So the 3rd step is to write after the trade. So we did before, we did during, and now we're doing after, and all the same things, how you felt, what you liked, what you didn't like, about which parts. And I want you to also write what you learnt about yourself, because that's gold. That is how you improve. That is how you don't take on losses in the future. So I want you to just think about this example. Have you ever argued with someone and you walked away and you later thought, I probably should have said this, because maybe it would have helped them to understand what you were trying to say. So trading is exactly the same. Trading is the reflection always feels clearer than the moment. And that's why you have to journal, because it gives you clarity. So yes, so it allows you to see the clarity before it's too late. And I just want to talk about some common mistakes to avoid if you're a beginner. So most beginners only journal bad trades because negative emotions outweigh the good ones and you don't need to reflect on the good ones. So the professionals journal every trade, every single one. The ones they liked, the ones they didn't like, the ones they could improve on. Specific feelings about specific things. So because improving isn't just about avoiding bad decisions, it's about understanding your tendencies, both good and bad. So on to topic number 4. How do the professionals think during volatility? So volatility is the storm of the market. It is where beginners lose the most money and where the professionals quietly make theirs. And the difference is not knowledge, the difference is nervous system regulation. So why are we talking about this? Deb, what's going on? What do you mean? Because during volatility, your mind starts to lie to you. It says things like, you need to act now. You need to take your money out now. Or everyone's going in on this one. You need to go in on this one as well because you don't want to miss out. And that's adrenaline, not intelligence, because the professionals know this. They train for it. The beginners chase the crazy storm. The professionals wait for the storm to slow down. And what do they look at? What do these professionals look at? They ignore the noise. They focus on structure. They ask, is the trend still intact? Are we near a key support or resistance? Are volumes increasing or decreasing? So volatility has patterns. Chaos is not actually chaos when you know what to look for. So 3 steps to thinking like a professional during volatility. So let's just take a breather. Let's take a breather. Because it has been quite a bit of notes to take down. So your breathing tells your brain when you're in danger. If you're breathing rapidly, that means that you either think or your brain is convincing you to think that you are in danger. So if you slow your breathing, you are able to get your mind a little bit clearer. So yeah, so that was step number 1. You just want to make sure that you have very slow breathing. Not very slow. You want to be breathing still, but you don't want to make sure that you're rapidly breathing, hyperventilating, because that's not going to help you. So step 2 is to zoom out of your chart. So zooming out reduces emotional noise. It shows the real direction between hidden behind short-term chaos. Step 3, you only want to enter when price returns to stability. So you never enter during the storm. You enter when the storm calms and direction reappears. So professionals don't chase the movement. They wait for the structure to return. So think of volatility like ocean waves. You don't try to walk into the ocean during crazy, insane, crashing tidal waves or insane tides. You wait until the waves settle into a rhythm you can read, and that is a key moment because you don't go swimming, especially if you are scared of swimming or you think you don't know how to swim, when there are crazy movements happening, because you're not used to that and you know you can't handle it. So you need to attribute that to the markets. So the markets are oceans and volatility is tide. Your job is not to fight the ocean. Your job is just to wait for the water to become readable. So some common mistakes to avoid. So trying to trade every move. This is not bravery. It is adrenaline and addiction disguised as strategy. So the professionals trade rarely, but intentionally. And just as a summary for all of the points that were made today, I just want to say the market trends, you don't fight the direction. You trade with the flow. You go with the flow, bro. Exit when you're exiting trades. You decide your exit before entering. Feelings are expensive. You want to journal. You want to study yourself, because self-reflection, self-improvement doesn't come from you not knowing. You need to know things about yourself in order to improve. So you want to study yourself as well as the charts. And volatility, you just wait for the calm, take a breather, because clarity lives in patience, not in urgency. And I just want to say, if you are still here, thank you for watching. And if you're watching this back after it's been streamed, thank you for watching all the way. And if today resonated with you, leave a comment that I am learning, so I know that you're here with me. And if you want a community that actually grows together, because we're all like-minded individuals, we want to leverage the systems in a way that work for us. So that is what we're doing on this channel. And if you want a community that actually grows together, the White Samurai team is here, open for you. And thank you. Thank you for watching. I hope you have a good day or a good night, good evening, wherever you are. And thank you for watching. This is Debbie Lee with the White Samurai team, and goodbye.